Hello, Accounting 441 students. This is our auditing class lecture on accounts payable and other liabilities. I hope you guys enjoyed our guest speakers. I hope you are able to draw from their experience and their wisdom. But what we're going to be doing during this video is reviewing chapter 14 from our textbook. And so I'm going to close the video and so that I can write on our PowerPoint. So give me a minute here. All right. And hopefully you can follow along. So let me also go ahead and share with you the PowerPoint. So I'm going to share the screen. Okay. Let's show our PowerPoint here. Let me do this so that I can actually draw on it. Actually, I think it looks better the other way. I think you have a larger view of it, and I think I can still draw on this. And so, chapter 14, accounts payable and other liabilities. And so, again, I always mention this as, when it comes to whatever item that you are auditing, it's always good to think about the big picture. All right. And so, before we were talking about inventory, revenues and things like that, where, big picture, our fear with those items was the fact that we might overstate those. Okay. Well, when it comes to liabilities, that's not the fear, is it? It's not like, oh, yes, I disclose that I owe more money than I really do. All right. No, the problem with liabilities is, or the fear of liabilities is that we might understate our liabilities. And so really that's, if you think about that as we walk through this chapter, all right, I think it'll make a lot more sense to you. So sources of accounts payable, all right, short-term obligations arising from the purchase of goods and services in the ordinary course of business, all right, so we purchased merchandise on account, we purchased supplies on account, those sort of things are payables and are accounts payable. And the difference, hopefully you remember, between an accounts payable and a note payable, right, is the fact that an accounts payable is a verbal promise, okay, whereas a note, there's actually, a documentation or a contract, right, where we've gotten somebody's written promise to pay us. Right? So invoices and statements from suppliers are the evidence, okay? It's usually not, a written document as far as I owe you this, okay? Interest-bearing obligations are not included in accounts payable, all right? They are included as bonds or notes, all right? And so, when we have those notes payable, this is the big difference, because the funny thing is when I was a student, all right, I was under the impression that, hey, accounts payable were short-term, all right, liabilities, and notes payable were long-term liabilities. That's not true, is it? All right, hopefully at this point you've learned that no. The only difference between an account and a note is that a note is written. Okay? A note can be long-term, and when we're talking about bonds here, okay, that is long-term, okay, but notes can also be short-term, and we covered that back in Accounting 201, all right, which probably for a lot of us seems like a lifetime ago. And so sources of accrued liabilities, okay, because again, these are current, all right, generally. Accrued liabilities, all right, sometimes referred to as accrued expenses, all right. We're familiar with this, again, going way back to chapter 3 in Accounting 201. And yes, we have covered that in intermediate and I'm assuming, in multiple places, all right? But they're those adjusting entries. Accrued liabilities, right, are expenses that we have incurred, all right, but we haven't recorded and we haven't billed, all right? And so I usually, do a little timeline, where we have 2 periods. Okay, this is December 31st, right? And so, I generally use the example of an audit, if you remember that. All right, so Coopers & Lybrand is auditing let's just say the Magoon Estates, all right, and that is over a 3-month time period, okay, so December, January, and February, okay? So that we can come out in March, okay, and have our financial statements, okay, and generally this is when we bill them, right? And so what we want to do, okay, and if this was a $300,000 job, we want to make sure, okay, that if we've earned, let's just say 1/3 of it, or $100,000, okay, we haven't recorded that, all right, and we haven't billed that, but we did the work, all right. That was actually accrued revenue. My bad. All right, accrued expense, all right, would be, if you were the client in this situation, all right, and the auditors actually did 1 month of the work. Okay, we haven't gotten the bill yet. Okay, but we owe them, all right, $100,000 because of the work they did. All right. Oh, sorry, I mixed those up. I was think on the revenue side versus the expense side. And so, yeah, salaries, interest, rent, right, accumulate over time, and management must make an accounting estimate at the end of the year. Okay. Note that if management does not make such an estimate, no entry will occur since the related transactions, example, interest, may have occurred months ago. Right? And so I do want to say that a lot of times when we were auditing our clients, they would, in a lot of cases, ask us to make our adjusting entries. All right, so we give them this list of proposed adjusting entries. They would review them, accept them, and then they would journalize those or book them into their system. So here's our mantra again: the objectives for the audit of accounts payable and purchases. All right. So again, use your understanding of the client and its environment. Consider the inherent risk, including fraud risks related to accounts payable. Okay, let me change my color. All right, that just seems more important, doesn't it? All right, obtain an understanding of the internal controls, okay, over accounts payable. Assess the risks, right, of material misstatement and design tests, okay, of controls and substantive procedures. Again, we want to substantiate the existence, establish the completeness, verify the cutoff and proper valuation, okay, and accuracy, and then also make sure that we have the proper presentation and disclosure. Right. So again, the objectives are the same for each item that we audit. So the primary concern in an audit of liabilities, like I said earlier, is understatement, right? The possible understatement or omission of a liability. Because obviously if we don't include, all right, that, oh, we owe Bob Jones, right? Well, then our liabilities look a lot less. And if our liabilities look less, okay, if you think about it, we have to have a related debit, right? Liabilities, so if we don't record the liability, we're also probably not recording the expense. And by not recording the expense, that artificially inflates your net income, or not artificially, fraudulently increases your net income. All right, and so aggregates of the financial strength of a company. All right, so this is why we are concerned. It conceals fraud as effectively as the overstatement of assets. Right, so the understatement of liabilities makes you look better on the balance sheet. Right, it also makes you look better on the income statement. Being accompanied by the understatement of expenses and overstatement of net income, which is what I just said. So the controls over the acquisition cycle, okay? And so, if you can think about this, again, a lot of these carry through from other areas, but, we want to have segregation of duties, all right? We don't want one person responsible for approving, journalizing, posting, and paying, all right? Which, yeah, when I worked for Faith Writing Company, I did all those things, all right? can we just say Faith Brad and Company had zero controls, except for maybe the fact that we used a bank account, all right, where we had some third party that was verifying the cash that we had, right? But whatever. So yeah, we want to make sure that we have proper approval of purchase orders, okay, so that people aren't just out there buying whatever they want, okay, or buying things for personal use, all right, in the name of the business. Numerical control of purchase orders and receiving reports, matching of the details of vendors' invoices to purchase orders and receiving documents, approval of vendors' invoices, pre-numbered checks, reconciliation of details of individual disbursements to controlling accounts. Okay, so using your subsidiary ledgers and controlling accounts, reconciling of vendors' statements to accounts, reconciliation of bank statements, use of budgets and analysis of variances, okay, and use of chart of accounts and review of accounting code. And so I hope you guys noticed, I did post a couple videos. One maybe we talked about last week with Far More, okay, and Far More I posted more for looking at manipulation of inventory, right? But then I also posted I think it's All the Queen's Horses or something like that. A really interesting story and well done, much better done than the Far More video, of this lady in Dixon, Illinois, who embezzled a mere $53 million, right, from a small governmental unit, right? And a lot of what she was doing here, okay, would have been caught, okay, had there been segregation of duties, right? Had there been, segregation of the reconciliation of details of individual disbursements, all right? And so, which it's a really good thing. I highly recommend you guys watch it. And it has a lot to do with beautiful horses and beautiful countryside and whatever. All right, so take the time and watch that, please. So here is a wonderful flow chart, okay? And yeah, since it's been maybe 100 years since I've done flow charting, and it's only been a semester since you guys probably have a better understanding of looking at this. But for the most part, all right, you want to make sure that we have segregation of duties, that you have proper authorization, that you have multiple copies going to different places for reconciliation later, all right? And so this follows it all the way from the purchase, all right, the receiving, and then ultimately the paying, all right, of those purchases. Potential misstatements of accounts payable, okay, and so, the description, all right, of this misstatement, inaccurate recording of the purchase or disbursement, okay. So again, fraud can happen, right? A bookkeeper prepares a check to himself and records it as having been issued to a major supplier, all right? And so in that, I think my cursor will actually work better for this, all right? In that, that video about the horses, that's what was happening here, all right? Now hers was a little bit more, more complicated. It was actually, they make a comment that, her system was pretty simplistic, all right? That could have been caught anywhere along the line, all right? And I think the comment was, hey, if it was more complicated, she might have been caught earlier, all right? But basically, she set up an additional checking account in the name of the county, all right? And so she would transfer money from one account to this account, where she had set it up as her being the authorized signature. And so she would actually cut herself checks, all right, to fictitious invoices. It's amazing. You guys need to see it, all right? And so, that's one way to commit fraud. Misappropriation of purchases. I think I mentioned this earlier. Goods are ordered but delivered to an inappropriate address or stolen, all right? Duplicate recording of purchases, all right? So, a purchase is recorded when an invoice is received from the vendor and recorded again when the duplicate invoice is received by the vendor, all right? Now, we didn't, Faith Routing Company, right, when I say we, didn't do something like that. But if I shared, I can't remember, if I shared this. I haven't shared it recently, but we had a situation where we had a liability. We owed a fabric company who had actually factored that accounts payable, right? So, they sold their receivable. For us, it was an accounts payable. And so we were supposed to pay, I think it was Citibank or something like that. Well, they were very aggressive in their collection procedures. And this was shortly after September 11th and, the downturn in the economy, and things were really slow. But I actually paid these guys. All right. I finally got enough money to be able to pay these guys off. I sent the check, right? Unfortunately, I was out, right? Probably in a board meeting. Yeah, surfing. And Tony got a phone call, all right, from Citibank, and they hadn't received our check yet, all right. But they start screaming about, coming over here and taking us to court, and taking our children, his children. I didn't have children at that time. They're really ruthless, all right. And so Tony, all right, does not follow procedures, and he just cuts them a check, right. We basically paid this liability twice, all right. So I guess this would be more on the disbursement of cash, all right, but it was the paying off of a liability, where if we would have used the proper procedures here for accounts payment, all right, where we set up the voucher system, okay, where there's proper approval for the payment, we wouldn't have paid these guys twice, because that's what Tony did. He cut them a check, right, and threw it in the mail, all right. I think when I came back, he was like, "Hey, I sent that check, to so and so," and I'm like, "What? Didn't you see I wrote a check, like days earlier?" If you would have just flipped the checkbook back a couple days, because he didn't even know how to get on the computer hardly. All right, he did, but he didn't do it. He could have easily saw that I had already printed and recorded that check for the payment. All right, but he just kind of got freaked out and cut a check, dropped it in the mail, and we double paid them. We double paid them in a time period where we did not have very much money, right? And unfortunately, we didn't catch this. All right, he didn't tell me right away, I don't think. We didn't catch it, all right, because I tried to stop payment on that check, all right, but it had already cleared. And it took us like 6 months to get that money back. And it was somewhere around, I want to say around $7,000, all right, which doesn't sound like a lot of money for a business. Okay, for me personally, that's a lot of money, but it wasn't. You know, it was a lot to Faith Riding Company, right? Especially in a very difficult financial period. All right. So moving past that, all right. The point is, if you follow the procedures, okay, that second payment of the liability would not have happened. So assessing risks of material misstatement, all right. Use the understanding of the client and its environment to consider the inherent risks, including fraud risk related to accounts payable. Again, this is the beginning of that mantra. Obtain an understanding of the internal controls and assess the risks of material misstatement and design further audit procedures. And so indications of risk of misstatement, all right? And so, what would identify as that, hey, something is incorrect here, right? Well, there's the subsidiary records, all right, are not in agreement with the general ledger, all right? So the accounts payable to Citibank, all right, does not agree, or the total of all our subsidiary ledgers does not agree with the general ledger numbers for accounts payable. Receiving reports and vouchers are used haphazardly. Okay, so again, we want to make sure these things are numbered. All right, we want to make sure that that is the procedure that is happening. Purchase transactions not recorded until payment is made. All right, this is just poor accounting. But they're like, yeah, because this would really mess with your cutoff or your timing, right? Many accounts payable long past due. Okay, well that's scary because if you don't have the money to pay, okay, are we trying to hide some of these things? Risks such as these indicate the need for additional substantive procedures. So additional tests and controls, right? Example of tests and controls: verify a sample of postings to the accounts payable control account, vouch to supporting documentation. So can I, ask the client, hey, can I see the source documents for this stuff, right? Test the IT application controls and if necessary, revise the risk of material misstatement based on those test of controls. Some of the substantive procedures, okay, perform further audit procedures, all right? So these are, when we see either weaknesses or we can't put our trust in the internal controls, we're going to do additional testing, all right? And so, this list is on the next slide, all right, that actually ties the procedure to what it allows or what it identifies. Right? And so, okay, the substantive procedure, obtain a trial balance of payables and reconcile with the ledgers. Okay? We're doing this, all right, for valuation and accuracy. Vouch, all right, balance of vouch balance payable to selected creditors by inspecting supporting documentation. All right. So generally, we do not send confirmations, but a lot of times our suppliers they'll send us our statements. All right. How much do you owe us? Okay, and whatnot. Okay. And so that's what we're doing. We're doing this to identify existence, occurrence, obligations, valuation, inaccuracy, and cutoff. Because they're going to tell you, hey, when are these due? Reconcile liabilities with creditors' monthly statements. I guess that was what I was using up above. I guess supporting documentation would be the actual invoice, all right? Where this one would be the monthly statements. Confirm accounts payable, all right? Generally, we do not mail confirmation letters, all right? But again, what we're doing is we're trying to identify that, hey, this is a legitimate liability and it has been properly recorded. Perform analytical procedures, right? So there is an accounts payable turnover ratio, all right? And there are other ratios that identify, or utilize the liabilities. And so we would be looking at those and comparing them to previous years. Search for unrecorded accounts payable, all right? Again, this is for completeness cutoff. Perform procedures to identify accounts payable to related parties and evaluate financial statement presentation, disclosure, and such. And so again, these tests, all right, give you confidence, all right, on all of these objectives, right, for the audit. And so they're, in this case, they're contrasting accounts payable versus accounts receivable, all right? Again, where we're talking about an asset, okay, we're really looking at existence, right? Are we overstating, those assets or, whereas in accounts payable, all right, the liability, we're really trying to, identify completeness, right? Because the tendency, right, is to not include a liability, right? Because that would have the ramifications of overstating the net worth of the organization, right? And it would, increase your net income. Other evidence available, all right, external evidence held by the client, all right, so the invoices and the various different statements, okay. Whereas evidence, all right, this sales invoices and receiving reports. Confirmations generally required, as I said, no, not really. We don't generally send out confirmation letters, but we do, all right, from previous chapters discussion, with our accounts receivable. However, all right, how do you go about looking, all right, for unrecorded accounts payable? Right? Well, there's various different steps. First of all, be alert during reconciliation, confirmations, and analytical procedures for unrecorded liabilities. So, good question to ask is why? Why isn't this included? All right, and then let the client explain why. Examine transactions recorded following the year end. All right, and so if we see payments made to somebody, pull those source documents and say, hey, was this a liability or was this a cash transaction? Because if you're paying something off, in the first week of January, let's just say year ends December 31st, businesses very rarely do COD, right? It's usually on account. And so really, you'd want to identify, hey, was that a liability and was that liability recorded? Examine year-end trends, compare your cash payments after year-end to accounts payable trial balance. Examine cash disbursements over a specific dollar amount during a subsequent period. All right, and so you might say, hey, look at any cash disbursement over 50,000, or Faith Writing Company would be over $500. Potential sources of unrecorded accounts payable: unmatched invoices and unbilled receiving reports. Okay. Vouchers payable entered in the voucher register, right, subsequent to the balance sheet date. Invoices received after the balance sheet date. So because really, if you purchase something, right, and it was FOB shipping point, and it's in transit, okay, it's unlikely that you got that invoice yet. You didn't get that into the mail, or they usually send the product, then they follow it up with your invoice. Okay? So you may not get your invoice until midway through January, okay? But because they shipped your product in December, okay, and it was FOB shipping point, you not only own that inventory, you also owe that liability. Then consignments in which client acts as a consignee, all right? You want to just check that sort of stuff too. And so here's, an example of a worksheet for unrecorded accounts payable, all right? And again, these are going to look different for whatever firm you tend to work for, okay? But really, we're just making sure that we're testing. And you can see in this case, right, we're actually asking them to book, all right, all these, this is the adjusting entries, okay, all these various transactions that we've identified that should be a liability, right? And so they would have understated, okay, these expenses, okay, and they would have understated the liability for that. That's $89,000, a nice pretty penny. Okay. So misstatements or omissions are judged based on impact to the financial statements. If they are material, all right, we definitely require that our client book that stuff. But in most cases, they're really, if you've got the documentation, you're not going to get a fight from your client to book that stuff. So I don't know that you really need to evaluate materiality. If you find a couple things that are like $50 or something like that, that might not be that material. But you might as well have accurate financial statements, as far as the liabilities, and the corresponding expenses or corresponding asset, right? Because you could be buying inventory on account. Amounts withheld, right, from employees. So these would be accrued liabilities, right? Again, the risk here: income taxes and other amounts withheld from employees, paid but not remitted as of the balance sheet date, may not be accurately recorded. Right? Possible procedures: trace amounts withheld to payroll summary sheets. Okay, test computations of taxes and other amounts withheld and accrued. Determine what amounts have been deposited in accordance with law, right? And so, I know we really don't do much in covering payroll these days, all right? However, the employer, okay, acts as the agent for both the federal and the state governments. It is their job to withhold, FUTA, SUTA, and the FICA taxes and the employees' income tax. And so if we hold those, we should be setting those up as a liability, right? So again, going back to accounting 202, 201, that was in 201, where we did payroll, right? We withhold that money from our employees, and then periodically we send that money to the corresponding agencies. All right, so the FICA and federal income tax withheld, we mail that to the federal government. The state stuff, we mail that to the state, and then the FUTA and the SUTA, the federal unemployment tax goes to the federal, and the state unemployment tax goes to the state. Right, and so a lot of people, all right, have withheld stuff from their employees, and in some cases, don't mail that money in, all right, to the IRS, or not the IRS, it's not the IRS, but to the Treasury Department, okay? They keep it. And actually, I remember when I started working at S&C, there was a restaurant. It kind of made the news. I think it was in Niles that had been doing this for a whole year. So they were withholding all the taxes from their employees, but they weren't mailing it on to the federal government or the government agencies. They were keeping it, all right? Obviously, that's fraud, all right, and tax. It's not even, would it be evasion? I'm not sure, but they got in a lot of trouble, all right? You know, and obviously the employees ultimately lost their jobs because the place went belly up. I don't know, does anybody remember that? Not like you're going to respond to a video, are you? All right, whatever. Moving on. Sales tax payable. All right, when we sell something, we also collect the tax. And again, we act as the agent. And at some time in the future, we have to forward that money onto the state. Right? So required to collect state tax imposed by the state and local governments. It is not an expense. All right, we're just collecting it. We're acting as the agent. All right. It is a liability until we mail it off. All right, to the state. Verify liability by reviewing a tax return, test reasonable amount, okay, and test invoice for the correct tax charge. Unclaimed wages, woohoo! So we paid our employees and they never cashed the check. Woo! We get to keep that money, right? No, all right. The law states that if somebody doesn't collect their paycheck or they never cash their paycheck, the employer does not get to keep that. They actually have to send that to the state, and the state holds on to it for further collection. So if you've ever seen watching late night TV, right, which I guess I don't do that anymore, you know, you'll see these, hey, you may have thousands of unclaimed dollars at the state, you know, blah, 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 blah. You know, we'll, if for a small fee, we'll go and see if you have any money, you know. Maybe your great auntie died and left it to you and you never got it, you know, all these sort of things. All they're doing is there's actually, if you go to the state website, there's actually unclaimed money, and you can actually look your own name up. All right, so don't pay somebody else to do that for you. You can actually do that if you are curious. But really, with unclaimed wages, right, the deal is it's subject to misappropriation, right? You're concerned with adequacy of an internal control, right? It should be not left for more than a few days, right? A prompt deposit in a special bank account, right? And so, you know, if it's something that hasn't been collected, you know, because generally checks are, they say 90 days, right? You do not want to put these dollars back into your general operating fund, all right? You want to keep it separate. Analyze unclaimed wages to determine, all right, credit represents all unclaimed wages after each payroll distribution, all right? And then debits represent authorized payments. A lot of times this is all handled by ADP or some sort of payroll service. And that's really why we don't spend that much time on payroll. Customers' deposits. Deposits on returnable containers or to guaranteed payment of bills, all right? Review the procedures, all right? Follow in accepting and returning deposits, all right? And so I know that we do this in intermediate. Okay, so I don't know if you remember that at all. Okay, but where I usually put it on the exam as one of the problems. All right, but you know, returnable containers. All right, and you know, the best example I can give you is in Michigan. You know, the soda pop can, you know, deposits. All right, and so when the, you know, Myers collects the 10 cents per can when you're purchasing it, okay, that isn't money that they get to keep. Right? That is money that they're ultimately going to have to pay back when you return those bottles, right? And so we go through a process, right, of, you know, whenever we get those deposits, you know, that would be a liability for us, and we would, you know, well, not hopefully, in the future, we're going to return that money to somebody. Now, if we use the proper procedures, okay, with deposits that are never returned, okay, we can actually record that as revenue, right? And that was generally the problem that we did in intermediate, right? And so, review procedures following the accepting and returning of deposits, verify a list of individual deposits and compare it to general ledger accounts, right? And again, we generally do not confirm these, right? Because, we don't generally keep a subsidiary ledger for the people that actually have those things, right? Unless they're large, like shipping containers or something along that line, right? That are material as far as value. Accrued liabilities, again, these are liabilities that we incurred, but we have not billed and we have not journalized. Okay? So obligations payable sometime during the subsequent period, right, for services or privileges received before the balance sheet date. Interest payable, accrued property taxes, right? Accounting estimates, right? So generally, in some cases, we utilize estimates for these. In some cases, we can, we can prorate it. It's like, oh, it's 1/3, 1/3, or hey, how many stories of that 50-story building did we complete? Right. So, when we did completed or a percentage of completion, with construction projects, we usually look at it from the perspective of the builder, right? But from the perspective of the purchaser or the one that's having the building built, right? They owe the construction company, right? And so, it's just the other side of the transaction. So yeah, there's a lot of estimates that are utilized in there. Basic audit steps: examine any contracts or other documents on hand to provide the basis for the accrual. Assess the accuracy of the detailed accounting records maintained for the category of liability. Identify and evaluate the reasonableness of the assumptions made that underlie the computation of the liability. Okay, so I use the percentage of completion. All right, another, so is it just some guy, all right, some foreman who has been working for us for 100 years that establishes that estimate, or do we do it by floor? Do we do it by costs? Because if you remember, that's how we did it in intermediate. Okay, we based our assumptions, okay, our percentage of completion based on the costs incurred to date compared to the estimated total cost of the project. So yeah, test the computations made, right, and setting up the accrual. So rework the numbers, make sure they didn't do a mathematical error. Determine that accrued liabilities have been treated consistently, all right, so they're not just doing it this year, that, if they did it last year, they better be doing it this year. Consider the need for accrual of other accrued liabilities not presently considered, right? And again, we're looking for completeness there. And for significant estimates, perform retrospective analysis, all right, of the prior year's estimates for evidence of management's basis or bias, I should say. And so, just, hey, is it in the realm of reality? After the fact, we can now see that, hey, yeah, this was a good estimate, or no, it wasn't a good estimate. Here's various different types of accrued liabilities. All right, yeah, just those are common ones. So just even knowing that list, okay, it could be ways to ask, all right, the client, hey, do you have any product warranties? All right, do we need to journalize something for that? What about vacation pay? Do you, accrue vacation for your employees? As far as audit documentation, all right, again, we're going to be recording all of our testing and our procedures and our conclusions in our working papers. We want to start off with a lead schedule of accounts payable, right? We want to have all the trial balances for various types of accounts payable, confirmation requests if we did use them for accounts payable, listing of unrecorded accounts payable, right, ones that we found. When do we look at this stuff, right? It's most effective, right, immediately after, okay, the balance sheet date. And the reason being is if we can find subsequent payments, all right, you know, we can then identify, hey, was that actually a liability that was not recorded? There's little value if we do it in advance, all right, you know, because, you know, there's the possibility of understatement. Some can be done at interim, okay, you know, things like accrued property taxes, amounts held from employees' pay, and things like that. So we can test their procedures and gain their control. All right. Well, that's pretty much it. All right. The end. I hope you guys have a great spring break. A couple things that I again want to highlight that I'm sure I mentioned in class. All right. Make sure that you add your classes for Ferris. Ferris opened up on Monday. So if you're interested in or if you don't know what classes you need, you can schedule an appointment with me. You can actually send me an email. I'll respond. There's a link there. We are currently doing Zoom meetings via or for advising, so I can share with you my degree and whatnot. I'm pretty much filled up this week. Next week I'm pretty wide open. So if you are curious or need that done, please schedule with me. Don't forget about the exam. All right, the exam is the first Thursday after spring break. All right, so again, our spring break is next week. All right. I will not be normally here. I will not have class next Thursday. But our third exam is yeah, that Thursday after spring break. All right, so we will not be holding class again. All right, in seat tonight we will be covering or we will be doing a review of the exam. All right, it does not include this chapter, so you don't have to freak out about it. All right, and so with that, I hope you guys have a great spring break, and we will talk with you. Well, actually, I'll be speaking with you tonight. We have some special guests. So again, I hope you enjoy that. All righty. Thank you. And you have a great spring break.